This is Al Brooks, and this is my price action trading course. The current module is about major trend reversals. Here are all the reversals that I talk about in the trading course, and right now I'm going to be talking about major trend reversals. Most reversal patterns are trading ranges. For example, double tops, head and shoulders tops and bottoms, rounding tops and bottoms, wedges, final flags, and major trend reversals are usually variations of double tops or double bottoms, where the second top or bottom is not necessarily exactly at the same level as the first, but functionally it's basically a double top or a double bottom pattern. All trend reversals are a change from a trend into an opposite trend. The opposite trend usually goes far enough for a swing trade. Most of the time, a big trading range develops. Sometimes you get a big opposite trend following a major trend reversal. Most of the time, you get a big trading range where the legs are big enough to take swing trades. Here are the steps required for a major trend reversal. First, you need a pullback in the trend that breaks the trend line, which means a breakout of the channel. Next, you want the pullback to test the moving average, preferably to go beyond the moving average. Next, you want the trend to resume. And once the market gets down in a bear trend to the old trend extreme, or once it gets up to the old bull high in a bull trend, you want another pullback to begin. And this pullback then grows into a reversal. Again, most reversals usually become trading ranges. So for example, here's a higher high major trend reversal, a trend line break. I don't have the moving average drawn in here simply to simplify the chart. So we got a trend line break, a higher high major trend reversal. The market trades down, but we ultimately go sideways. Here we have a bear trend, a trend line break, a higher low major trend reversal. The market goes up, but again within a trading range. And then a lower high major trend reversal and a higher low major trend reversal. All the reversals go far enough for a swing trade, but each reversal ended up in a large trading range rather than in a new sustained trend. The major trend reversal does not confirm a new trend. It's the setup that can lead to a new trend. What's required to confirm that a reversal has taken place? If you're talking about a bull trend to a bear trend, you need a bear breakout of the channel and then a series of lower highs and lows. And if you have a bear trend and it's converting into a bull trend, you need a break above the bear channel, and then you need higher lows and highs. And at that point, you have a bull trend. The name major trend reversal, the abbreviation MTR, I'll use this on a lot of the slides. It's not major. So the word major is misleading and implies it's more important than any other type of reversal, and it's not. It's just one in a long list of reversals. And a major trend reversal, it's not even a reversal, at least not yet. It's a setup and not a reversal. It allows traders to enter early before the reversal actually is confirmed. The early entry allows for a minimum risk and a maximum profit. The trade-off is probability. Whenever you're going to get a lot of profit with very little risk, the chance of success is small. So a lot of major trend reversals have probabilities of 40 to 50% and not 50 to 60%. Major trend reversals, they're great setups. It's the single best setup for beginners, and it should be the focus of everyone starting out. And it's also the best setup for experts as well. It has the strongest trader's equation. Again, an excellent trader's equation. The reward is usually at least 2 times greater than the risk, and it occurs often enough so that you can make a living trading it once you get good at it. On any given 5-minute chart, there's usually at least one a day. The advantages of a major trend reversal. First of all, time is on your side. You can usually anticipate the formation of the major trend reversal setup many bars in advance. It gives you a lot of time to evaluate the setup, so it's much less stressful. It's also easier to manage than a lot of trades. There's less thinking. You can rely on a list of simple rules to manage your trades. Nothing is without problems, and there are disadvantages to major trend reversals. And one of the biggest problems is that in return for the big reward compared to the risk, the probability is often only 40%. So 60% of the trades are either small losers or small winners. You cannot have big losers because your stop is not all that big. It's also difficult not to exit early because, for example, if you're starting to get a bull trend, the first pullback or two is sometimes big enough to make you wonder if the bear is resuming, and it's difficult to rely on your stop and hold through that test of your entry price. I mentioned it's easier to manage than most trades. You put your stop, your initial protective stop, beyond your signal bar. So in a reversal up, your signal bar is a bull signal bar, bull reversal bar. Stop goes below. And once you have a reward equal to twice the size of your risk, you take half off, for example, and you move your stop to break even, and then you hold onto the trade until you get a reversal in the opposite direction or until the end of the day. Again, a very good trader's equation, so it's a good trade. The probability, 40 to 50% most of the time. It can be higher, but usually 40 to 50%. But the reward is at least 2 times the risk and sometimes greater. When the probability is very high, chances are the reward is going to be smaller or the risk is going to be larger, because whenever you have something that has a very high probability, you cannot have also a high reward compared to risk, because there won't be an institution willing to take the other side of that trade. So whenever something looks very likely to happen, in general, the reward is going to be about the size of the risk and not 2 or 3 times bigger. Okay, probability of only 40%. How can you make money? Let's look at an E-mini trade where you're risking 2 points to make 4 points. A reward 2 times the risk. If you take this trade 10 different times, 40% chance of success, so you have 4 winners at 4 points each, you make 16 points. Let's say you have 6 losers at 2 points each, which is a worst case scenario. You lose 12 points. And at the end of 10 trades, you have a net of 4 points profit. So it's a positive trader's equation. The math is actually much better than that, because you'll exit most losers before you get a 2-point loss. So on the 6 times out of 10 when you don't make 4 points, you will not lose 2. In fact, you won't lose on all 6 of those losing trades. Some of those trades will be break even, some will have small wins. Also, the probability is usually better than 40%, might be 45%, 50%. And sometimes trades will go much further than 4 points. And all of these factors make the result better than the numbers I showed on that prior slide. So how do you trade major trend reversals? I have a series of modules about trading major trend reversals later in the course. After any big change, like a breakout, a climax, or a reversal, a major trend reversal, the minimum likely objective is TBTL, 10 bars, 2 legs in the opposite direction. So if you have a bear trend and then a major trend reversal bottom, you should look for at least 2 legs up and at least 10 bars. If the major trend reversal pattern is much bigger than a typical pattern, you'll probably get much more than 10 bars up, because if it's a big pattern expanding or covering 30, 40, 50 bars, it's probably a major trend reversal on the 15-minute chart, and you'll probably get 10 bars up on the 15-minute chart, which would be 30 bars up on the 5-minute chart. Okay, I said the major trend reversal is a setup and not an actual confirmed reversal. A setup is made of 2 things. Context, it has to make sense that a reversal would be taking place, plus the signal itself, the signal bar. For example, The context, let's talk about a bull trend. You need a break below the trend line, a break out of the bull channel. You need a test of the moving average, not absolute, but usually the sell-off is enough to hit the moving average or go below. And then you need a resumption of the bull trend. And then once the market gets to the area of the prior bull high, you need a strong bear signal bar. So you need context and you need a signal bar. Major trend reversal tops, they're all variations of double tops. Sometimes the second high is a little bit higher and you have a higher high major trend reversal. Sometimes the second high is a little bit lower and you get a lower high major trend reversal. Again, all major trend reversal tops are variations of double tops. The second top may be a little above or a little below the first top, but the basic principle is the same. The market's testing the high of the bull trend and it's deciding whether to break out and resume the bull trend or whether to reverse. A major trend reversal bottom, basically all are variations of double bottoms. Sometimes the second low goes a little bit below and you have a lower low major trend reversal. Other times it doesn't quite get down all the way to the prior bear low and it forms a higher low major trend reversal. All major trend reversal bottoms are simply double bottoms, and the second bottom may be a little bit above or a little bit below the first. It may be exactly the same as the first. The principle is the same as with the double bottom. The market is testing the low of the bear trend, and then it's deciding whether it should break out and resume the bear trend or reverse. For example, here's a double top major trend reversal. It's exact to the tick. So we have a bull trend, a break of the trend line, a test of the moving average, did not quite get to the moving average, and then a resumption of the trend, but this resumption is much weaker than the initial trend. And if you looked at some kind of indicator, stochastics, or some kind of oscillator, you would see a divergence here. You don't need the oscillator to be able to tell that this leg is weaker than this leg. So you know there's a divergence. So we have good context, a trend line break, moving average test, a weak rally testing the prior high. However, we do not have a strong signal bar. We have a doji signal bar. You can take that short. It's a reasonable short. When in doubt, it's usually better to wait for a second entry. And here we have II pattern, an inside bar, and then a second inside bar. And that would be a second attempt to reverse the market down. So that would be a higher probability setup. Now, I said this pullback did not quite reach the moving average, and it's true, but it's also an 8-bar long triangle. 3 pushes down, 1, 2, 3, and a triangle after a protracted bull trend often becomes the final flag of the bull trend. So it's a major trend reversal and a final flag reversal. And there was enough selling pressure within this triangle to warrant looking for a short on the test of the prior high. You know, you prefer the sell-off, the break below the trend line to touch the moving average or fall below it as a sign of selling pressure. But here we have 3 pretty good bear bars, and then there was a 4th bear bar here, and we have 2 other bear bars here. So we're accumulating selling pressure. So for a major trend reversal top, it's a reversal from a bull trend to a bear trend. You need to sell off the breaks of the bull trend line. In other words, a breakout below the bottom of the bull channel. You need it to reach around the moving average as a sign of selling pressure. And you can have other ways to demonstrate selling pressure as well. For example, you can have a few very large bear trend bars, or you can have 10 or more weaker bear bars showing that the bears are beginning to exert control over the market. Whenever there's a strong bull trend, you always draw a trend line before there's any sell-off. And it's a reminder that a major trend reversal might follow a break below the trend line. In other words, a bear breakout below the bull channel. After the break below the bull channel, if the bull resumes but reverses down again after testing the bull high, the reversal is a major trend reversal. And again, the test of the old bull high can be a lower high an exact double top or a higher high. If the reversal is a higher high or a double top, it's usually followed by a lower high major trend reversal. A moving average gap bar is a bar with a high below the moving average. So if you have a bull trend and then a sell-off below the bottom of the bull channel and below the moving average, and you have a bar with a high below the moving average, that often leads to the final leg of the bull trend. It usually leads to the leg up that tests the old bull high and begins the reversal into a trend down. So here's an example. We have a bull trend. Here's a channel, a strong break below the bottom of the channel and the trend line, and below the moving average. And then we have a second strong bear bar. So we're starting to accumulate selling pressure in here. We have a triangle, 3 pushes down, and then a rally into a new high. So a higher high, and then we have a small bear bar for the signal bar, and the market reversed down. So you sell 1 tick below the low of that bar for a swing trade down. You're looking for at least 10 bars and 2 legs. So we have 10 bars here, but it's only 1 leg. We have a rally and then a second leg down. However, this rally set up a lower high major trend reversal. We have a bull trend. I could redraw this trend line so that it goes over here. Okay? So this would be the break of the trend line, and this would be the lower high major trend reversal and the sell-off. And then here we have a double top, or you can view it as another lower high. So we're starting to get lower lows and lower highs, and we're starting to convert into a bear trend. Here, by the way, is an example of a moving average gap bar. We have a bull trend, a strong bear breakout through the bottom of the trend and below the moving average. And here we have a bar with a high below the moving average. And here we have a couple more bars with highs below the moving average. And these bars usually lead to the final leg of the bull trend, which it did here. After a lower high major trend reversal, why would you not take profits here? Because after a major trend reversal, you want at least 2 legs down. And this is just 1 leg down. So here, you'd still stay short with a stop above the high of your signal bar, looking for at least 1 more leg down. This is a daily chart of Nike. So these signals work on all markets and all time frames. Here's ExxonMobil with a 5-minute chart with a series of major trend reversals. Strong bull trend, trend line break below the moving average, several good bear bars, lots of selling pressure in here. So you have to wonder if the next leg up will lead to a major trend reversal. The bears tried to reverse here and failed, and they have another strong leg up to this point. When it's that strong, I would not take the first signal. Here's a second signal with a good bear signal bar. That would be a reasonable short. The market reversed up again, and now we have 3 pushes up. 1, 2, 3. This sell-off, a lot of selling pressure again. Broke below the trend line, broke below the moving average. This could be the final leg of the bull trend, especially since it's a 3rd push up, and a potential final flag. A lot of times when you have a small high 2 late in a trend, it becomes the final flag of the trend. So this would be another short. And then we went slightly, I can't tell if this went above this, it looks like it might be a little bit below that. But anyway, it's a second entry short for a higher high major trend reversal. We have, here's a high, here's a higher high, and here's a second entry short. We sold off again, but again found buyers. So we may still be channeling up, forming higher lows and higher highs. And then we have a very sharp rally up here. Not a good signal bar, but this turned out to be an exhaustive buy climax and led to a sell-off. This, I think, is a pretty aggressive sell after those 4 bars up. When these are forming, when you're getting the best looking bars late in a trend, you always have to be suspicious that it's a climactic end of the trend. Also, the market now is selling off after every new high. Went above here, sold off. Went above here, sold off. Went above here, sold off. So when we go above a prior high, the market will probably sell off because we're transitioning from a bull trend into a trading range. Trading range, buy low, sell high. We're high, better to be selling. For a major trend reversal bottom, it's a reversal from a bear trend to a bull trend. You're looking for a bear trend, and then you're looking for a rally that breaks above the bear trend line. In other words, it breaks above the bear channel. You'd like it to reach around the moving average. The stronger the rally, the more likely you'll get the reversal on the test down. And you want the rally to have buying pressure. For example, it can have a few very big bull bars, or it can have 10 or more weaker bull bars. But you're trying to see some kind of buying pressure in that test up, so that when that market tests down again, the market will probably either be in a trading range, in which case you can buy low, or it could be reversing in a major trend reversal. So whenever there's a strong bear trend, always draw a bear trend line before there is any rally. And it'll serve as a reminder that a major trend reversal might follow a break above the trend line. After the market breaks above the trend line, if the bear resumes again and reverses up after testing the prior bear low, that is a major trend reversal setup. The test is some kind of a double bottom. It can be perfect. It can be a higher low. It could be a lower low. If it's a lower low or a double bottom, it's usually followed by a higher low. That's because a major trend reversal usually has two legs up. So if you have a lower low, you want to have two legs up, you'll have to then have a higher low to start the second leg up. Again, that bear trend, when it rallies to the moving average, a lot of times it'll go above the moving average, and you'll have a bar with a low above the moving average. In other words, there's a gap below the low of the bar and the moving average. And once you have a gap bar in a bear rally like that, it usually leads to the final leg of the bear trend. So it could be a sign that the next leg down might be the final leg. So you look for a reversal up after the market works its way back down to the area of the bear low. Here's a bull trend. Sideways move that broke below the trend line, and it broke below the moving average. Here's a gap bar. So that's good selling pressure. If the market was able to put a bar completely below the moving average, that means the bears were reasonably strong. A gap bar usually leads to the final leg of the trend, which it did here. So you start looking for shorts. Here we have a small double top. You could short below here, you could short anywhere up in here if you use the appropriate stop. I talk about trading these patterns in a later module, but let's say you shorted here. You'd expect 10 bars, 2 legs down. We got 1 leg down, and the market continued down the following day. Here, a bear trend all the way down to here. This segment of the bear trend had a rally that broke above the trend line. I did not draw a trend channel line below, but this is a bear channel. So we get a break out of the channel, and we now have a gap bar, a bar with a low above the moving average. So there's a gap between the low of the bar and the moving average. That means there's pretty good buying pressure, and it could be the final, it could lead to the final leg of the bear before there's a reversal. And then at the bottom, there's a decent bull reversal bar forming a lower low major trend reversal. Here's a lower low and then a higher low major trend reversal. We get a bear trend, breaks the trend line, no good reversal until we get all the way down here. It's actually a wedge lower low, 3 pushes down, 1, 2, 3, and a decent reversal bar, especially after a potential final flag. Also a wedge bottom using this low, 1, 2, 3. If you use this low, this is a break below the bear trend channel line and a reversal up. So it's a decent lower low major trend reversal. After lower low major trend reversals, the market usually then forms a higher low major trend reversal, which it did here. And it's basically a double bottom with this pullback. So this is a second entry long. Here's an example of a bear trend, a trend line break and a gap bar. So the next leg down might be the final leg of the bear. And we have a lower low major trend reversal here. So you'd expect that after some rally, there would be a pullback and then a second leg up, and that pullback would be a higher low major trend reversal. This is the daily chart of the EWZ, which is a tracking ETF for Brazil. Again, bear trend, so you draw a trend line. We have a break and it hits the moving average, and we have enough buying pressure to keep the market up for about 10 bars. So you think that the next leg down, you may have a major trend reversal. We have a strong sell-off, a sell climax, big bear bars closing on the low, and then we have a bull inside bar, reasonable buy setup for a potential major trend reversal. We have a higher low, not a good signal bar, it's still worth buying, and then we have another higher low, this time with a bull bar. You place a buy stop one tick above its high, did not get filled here, did get filled here, and that's a very good setup for a swing trade, and we broke to the upside. So it was a lower low, major trend reversal, followed by a higher low, and the higher low had a second higher low. This is a triangle. Anytime you have three pushes up or down, it's a triangle. We have a push down here, number 2, number 3, so it's a triangle. Expanding triangles, they're all major trend reversals. Sometimes the legs are not quite as strong as I'd like them to be with traditional major trend reversals. But in general, the second, third, or fourth leg of the triangle always breaks the trend line and comes close to the moving average. And even if it does not, I still treat it like a major trend reversal. So all expanding triangles are variations of major trend reversals. So anytime you see an expanding triangle, treat it like a major trend reversal. So what's an expanding triangle? It's a triangle that gets wider. So here's a push up, another push up, another push up. Here's a push down, another push down. So we have 3 pushes up, so there's a triangle. But the second push down is lower than the first, so it's an expanding triangle. Now we have a bull trend and a trend line break, but the trend line break is only a couple of bars. That's normally not enough selling pressure to look for a higher high major trend reversal. But given that it's an expanding triangle, I think there's enough selling pressure from the first leg down and then the second leg down to go ahead and take the short, especially when you have a perfect 2-bar reversal with the second bar closing on its low tick. So if you're looking at this as a major trend reversal short, I probably would not take it. If I did not see the expanding triangle, I would say not enough selling pressure on this break below the trend line. So if you treat it as simply a higher high major trend reversal, I'd say probably not ideal. I probably would take it because the single bar was so good and we might be transitioning into a trading range. But if I saw that it was an expanding triangle, I definitely would take the trade. This is what I mean by the expanding triangle. 3 pushes up. Obviously the second one went above the trend line connecting the first and third. I could have drawn the trend line across here and it would have gone up here somewhere. It doesn't matter. It's basically an expanding triangle. And that overcomes the lack of selling pressure in this break below the bear trend. Because you had 2 legs down, and even though this is the one that was the breakout below the bear trend, these 2 bars, it's also the second leg down. So we've had pretty decent selling pressure in the first 2 legs down. Here's another expanding triangle, 3 pushes down, so it's an expanding triangle. Now, why is this a higher low major trend reversal? Right? Because we had a bear trend, big gap down, strong bear spike, a big breakout above the moving average, and now we're forming a higher low. And every expanding triangle is a major trend reversal. So we had the earlier expanding triangle up here, so an expanding triangle top for the major trend reversal. And expanding triangle tops are usually followed by expanding triangle bull flags, which is the case. And now we have an expanding triangle bottom, a higher low, major trend reversal. Bear trend, trend line break, and a higher low. There's the trend line, and here's the break above the trend line. Again, all expanding triangles are major trend reversals. Here's a bear trend, a break above the trend line, and then a lower low. You can look at this and say, yep, lower low major trend reversal, adequate signal bar. But you can also look at it as an expanding triangle. 3 pushes down, 1, and then second push, and then third push. And then the first push up was followed by a higher push up, so it's an expanding triangle. Again, I could have drawn the lines across the lows of 3, and it would have put this line down here. It doesn't matter. It's close enough, and in trading, the best you usually get is close enough. This is still 3 pushes down, 2 pushes up, and the pattern is expanding. Expanding triangle, it's always a major trend reversal, so a reasonably good buy. Now, you've heard me say repeatedly that most reversals fail, and the reversal pattern that I tend to pick on the most is the head and shoulders pattern, because that's the one you hear the most on television or in books, that, oh, wow, it's a head and shoulders top or it's a head and shoulders bottom, and therefore the market will reverse. No. If you see a head and shoulders top, it's probably a bull flag. If you see a head and shoulders bottom, it's probably a bear flag. Every now and then, you get a reversal instead of a continuation of the trend. So sometimes, rarely, head and shoulders tops lead to reversals. Head and shoulders bottoms sometimes actually lead to reversals. But most head and shoulders bottoms become bear flags and the market continues down. Most head and shoulders tops become bull flags and the market continues up. Protective stops, I have a module on stops and you can refer to that. The one important rule about stops is no matter what size stop you choose, always make sure that the dollars that you're risking are within your comfort zone. And if they're not, trade much smaller. Immediately cut your position size in half. If you're ever worried about losing money, you'll not follow your rules and you will lose money. So anytime you're worried about losing money, you will lose money because you will not be objective, you'll be emotional, and you're trying to follow what the computers are doing, and they're not using emotion. So you're doing something that the computers are not doing, and you will lose. Okay, if a trade requires a stop that is very large, let's say 3 times bigger than what you usually use, reduce your position size to a third or even a quarter. Trade very, very small. Okay, so if a stop has to be 3 times bigger, your reward has to be 3 to 6 times bigger than normal, and you will end up making the same number of dollars even though you traded very small. Most of the time, major trend reversal signals become small winners or losers. Big winners come less than 50% of the time, but you need that occasional big winner to make major trend reversals worthwhile. So you have to treat them as swing trades to make sure that you capture those big winners. And by a big winner, I mean a reward at least twice as big as the risk. And that you need at least twice as much as you're going to risk to overcome the lower probability. Cardinal rule of all trading, always make sure that for every trade, at a minimum, your profit target is at least as big as your protective stop. Never go for a profit that is less than your protective stop. Because if you do the math, you'd have to be right 80 or 90% of the time to make a profit. And very few traders can be that good, day after day, year after year. So don't worry about trading that way. Instead, look for bigger profits. Always want a profit at least as big as your stop, and preferably twice as big as your stop. The initial protective stop is beyond your signal bar. So if you're buying a bull reversal, the stop is below the signal bar. If you're selling a top, the initial protective stop is above the signal bar. If the signal bar is too big and you don't want to risk all the way to beyond the bar, risk to at least beyond the middle of the bar. You can also risk a money stop. So instead of a price action stop based upon the bar, you can risk a fixed number of ticks, like 8 ticks or 10 ticks or 20 ticks or 50 ticks from your original entry price, depending on the individual market. So here's a big signal bar, and traders might be nervous risking all the way to the top of the bar. If they did, they have to trade small, right? If your risk is, let's say, twice as big as normal, you have to trade half size. Alternatively, you can trade your normal size, but put the stop, instead of all the way above the top of the signal bar, maybe just a little bit above the middle of the signal bar. So here's the signal bar. You'd short 1 tick below its low, and you might put a stop just above the midpoint of the bar. higher chance of being stopped out, but you're risking less, and you'll probably make about the same as trading half size and putting a stop above the top of the signal bar. Okay, an example of protective stops using an expanding triangle. Again, it's a form of a major trend reversal. So this is an expanding triangle bottom that I'll be talking about. And the minimum objective with an expanding triangle is always the opposite side of the triangle. So if you have an expanding triangle bottom, the minimum objective is a test of the top of the triangle. Here's your signal bar. Here's your entry bar. Your initial stop is one tick below the low of the signal bar, and you're trying to hold on to a profit target at the high of the triangle. And this is the end of the module on major trend reversals.